Yeah. Well, their Ethereum and Bitcoin are public tokens. And so their price isn't going to be purely anchored on fundamentals. They're
Yeah.
going to be reflecting investors' perceptions because both Bitcoin and Ethereum are not mature platforms. Their best utility and growth and innovation are in the years ahead, right? So we're 10 years in, but there's more growth in the future. The percentage of market share of crypto of total assets is so small that we know that mathematically that's true. When you have something that has a hyper growth on ramp and you're discounting the future, it's going to be very volatile. So does Ethereum's price going from 4,800 to 2,800? I mean, that is a staggering decline, but that probably is a minor change in 2030 fundamentals that is being priced and repriced by investors. And that's why there's hyper volatility.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now, guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge.
Tom Lee breaks down where Ethereum stands and the Crypto 10110 crash. Join us to uncover the insights together now.
It's one reason why BitMine ended up engaging Tom DeMark as a strategic advisor, because he is the king of sort of price discovery. He is the father of systematic timing. And in our conversations, when he looks at Ethereum, he sees what looks like engineered or systematic liquidation taking place. So there is someone that is in crypto, we know it's market makers play a big role, but there's someone that is probably capital constrained and is therefore bleeding or having to sell reflexively as price falls. That process is painful, but in his sort of rough timing range, his downside target, and we talked about this a few weeks ago, was 2,500 for ETH. So I think we're so close to that. It would be ideal actually for us to actually bleed to that level, because then that is creating what he calls a buy setup. A bottom in prices for him is when the last seller has sold, so that a stock or crypto no longer falls on bad news. I mean, that's what he thinks makes a bottom. So it would, I think, be a better situation to see crypto prices bleed lower to 2,500. But it could reverse at any time. I mean, because markets don't have to do what ends up being an ideal scenario.
Bitcoin sitting around $87,000 has everyone asking the same question. Is this a golden buying opportunity or just a dead cat bounce? Recent market action has pulled several key indicators back to levels not seen in years, and that's giving traders a lot to think about. Analysts are seeing major shifts in risk-reward metrics, and the conversation around whether Bitcoin is truly bottoming out is getting louder by the day. One of the most eye-catching signals comes from CryptoQuant's data showing the Sharpe ratio dropping into its green zone for the first time since mid-2023. This metric measures risk-adjusted returns, and historically when it sinks this low, Bitcoin has been gearing up for multi-month trend reversals. Similar setups appeared in 2019, 2020, and at the end of the brutal 2022 bear market. While this doesn't guarantee that the current dip is the bottom, it does suggest the quality of future returns may be improving if volatility cools off. Another powerful signal is the Bitcoin heater, which tracks heat in futures, perpetuals, and options. It has fallen to its lowest level since November 2022, hinting that Bitcoin may be oversold and primed for movement. Still, not everyone is convinced. Some traders, including Peter Brandt, argue that Bitcoin's bounce from the 80K zone could still be a classic dead cat scenario within a broader downtrend.
When someone says, what is Bitcoin? I think everyone really accepts it as it's a store of value, really a really good way to store value. And That's accepted today. In fact, someone might say that's like a Lindy effect, that people believe that. When we first started writing about Bitcoin in 2017, and digital gold was one way to sort of argue Bitcoin's value, it was not accepted because many people said, well, come on, I mean, it's just code. I mean, how can code store value? Or why can't there be 100 Bitcoins? Or look, I could create a new Bitcoin tomorrow, or I could fork Bitcoin and create a new Bitcoin, or I can't buy. I remember one client saying they couldn't buy a bottle of water with Bitcoin, so how could it even be valuable? So, but of course, all those arguments fell away. And now we have digital gold, Bitcoin store value. Even as gold gets tokenized, which I think will compete with Bitcoin to an extent, you still have Bitcoin, which is a really good way to store and transfer value. But Wall Street is also understanding there are a lot of virtues to a blockchain, and it's the ability to not only store value, but to store information and to actually transact and conduct and actually re-architect almost everything that Wall Street does, but they need a smart contract platform. And so that's where all these other L1s start to become a lot more important to Wall Street's future. Because if the big banks, the blue chips, build stable coins and they're going to tokenize stocks and let stocks trade 24/7, and then innovate that too, which I discussed at the Cantor, which is like things like factorize a stock. So no, just like in the bond market where you can factor a bond, we can factor Tesla so that you're only buying the implied future value of Optimus Prime. So instead of asking Tesla to make itself a tracking stock, you can synthetically create that on the blockchain. So you can't really do that on Bitcoin. So you have to build it on a smart contract.
BlackRock has shocked the crypto market once again by unloading $344 million worth of Bitcoin and Ethereum in just minutes. Fresh data from Look On Chain revealed that the asset management giant transferred 2,822 BTC and 36,283 ETH to Coinbase Prime on November 24, continuing a rapid selling trend that has caught the attention of traders everywhere. The move happened fast, fueling speculation that BlackRock is actively reducing its exposure to the market, despite early signs of recovery. The timing is especially surprising. Bitcoin's sharp correction has slowed, and sentiment has begun to shift as traders look for a rebound. Yet BlackRock seems unmoved, pushing through more deposits even after dumping over $2 billion in BTC and ETH just last week. Many analysts believe the firm is intentionally deflating its holdings, though no official explanation has been offered. This aggressive selling streak has raised concerns about its impact on the market's fragile recovery. Bitcoin is currently holding around $86,237, with only a slight dip over the past 24 hours, while Ethereum has managed a modest bounce to $2,828. Despite the stability, BlackRock's ongoing moves suggest caution, and possibly more selloffs may still lie ahead. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoin Zela for daily news all for free. That's all for today's video. Until next time.